Hi everybody, welcome to the webinar. My name is Chris Ashton. I am the head mentor at the Corellian Academy. Today's webinar is all about the US presidential election between Kamala Harris and Donald Trump, which takes place on Tuesday, November the 5th. As a trader with over 20 years of experience who worked at UBS and Barclays, I can tell you this is a unique event. Why? This election can significantly influence market sentiment and increase volatility in some of the instruments that you trade, not only for the next 2 weeks in the run up to election day, but for the days, weeks, and even months afterwards. With me on the webinar today are Maurice Pomeroy, our strategy mentor at the Corellian Academy, and Richard Adcock, our award-winning technical analysis mentor. Gents, would you like to introduce yourself? Maurice, over to you.
Hi, Chris. Thank you. Welcome, everybody. My name's Maurice Pomeroy. Just a very quick background. I've traded in just about every market there is to trade. I've worked for a couple of very large banks on that side of things, investment banks, and the experience I've gained in there, I'm hoping to share with you over an event like this when we're talking about volatility and risk as well as strategy. So I hope you look forward to it. We've got a lot to offer, and I'm going to pass over to Richard now.
Thanks very much, Mo. Good evening, everybody, and welcome. My name's Richard Adcock. I've been a technical analyst now for nearly 40 years at various institutions, ranging from investment banks to hedge fund, where I've taken roles on the strategy and trading side. Now, tonight, I'm going to be talking about using technical analysis to also highlight risk management and to try and pinpoint where we can gauge important levels are within areas of markets which are seeing increased volatility that perhaps we may see over the announcement of the election results. So that's later. For now, I'll hand back to Chris. Thanks very much, Chris.
All right, great. Thanks, boys. Let's move on to looking at the structure of today's webinar. Now, I'll start the webinar by briefly outlining what's at stake in this year's US election. Then from that point onwards, the webinar is split into 3 sections focused on 3 key instruments you may trade. These are the NASDAQ 100, gold, and sterling against the dollar. For each topic, we'll outline the events of 2016 and 2020 to provide some historical insight into the volatility surrounding US elections. Although I should say at this point, this does not mean that we can predict future performance based on these past events. Moving forward, we will highlight some of the things that you can do to manage your risk over an election before looking at the macro factors impacting each instrument right now, which are still likely to be key drivers over the US election. Next, we will talk more specifically about what a Kamala Harris or Donald Trump win could mean for the direction of the NASDAQ 100, gold, and sterling against the dollar, and then finish by providing a technical analysis update of each instrument for you to help identify some key levels as we move forward into election night. If you do have any questions, please put them on the Zoom Q&A or the chat, and one of us will either answer them immediately or we will answer them live at the end of the webinar. Okay, so that's that. Let's briefly discuss trading a US presidential election. An election can be a highly volatile period for traders because it creates uncertainty about future government policies that could impact all markets, but especially US stocks, safe havens, and the dollar. Investors often react to news about the candidates' positions on key issues like taxes, regulations, trade, and fiscal policies, as well as to shifts in polling data, interviews, or debate performances. This volatility can create trading opportunities as market prices can move sharply before the election, during election day, and after the results have been published, providing chances to capitalize on short-term price swings. However, this volatility also increases your trading risk. Market movements can be unpredictable, driven by news events, headlines, or surprises, leading to significant losses if positions aren't managed properly. So effective risk management is crucial in this environment, and that's why we discuss this further later in the webinar. Right, that sets the scene. Let's quickly run through what's at stake in the US presidential election 2024 on November the 5th. The US presidential election is between Kamala Harris, the Democrat candidate, and Donald Trump, the Republican candidate. The winner needs 270 electoral college votes to become president. The number of electoral college votes for each state is roughly in line with the size of its population. For example, California has 54 electoral college votes, while a less populous state like Delaware has just 3. Now, generally, states use a winner-takes-all system, awarding all their electoral college votes to whichever candidate wins the most votes from US citizens in their state. So a candidate can become president by winning several tight races in certain key swing states, which change their allegiance election to election. The key swing states for you to think about are Arizona, Georgia, Michigan, Nevada, North Carolina, Pennsylvania, and Wisconsin. Also at stake on November the 5th is control of Congress. These are the lawmakers who set policy in Washington. Congress is made up of the Senate and the House of Representatives, and control of Congress is important as it determines how easily a new president can turn their election policies into law. This is interesting for all traders, as basically all markets, because these markets will move depending on the likelihood of a clean sweep of the presidency and Congress for either party, or in the case of a split Congress, whether it could mean political gridlock. Currently, the Democrats control the Senate with a slim 51 to 49 seat majority. However, on November the 5th, 33 of those 100 Senate seats are up for re-election. 23 of these are currently held by Democrats and just 10 are held by Republicans. So things could get interesting there. The Republicans control the House of Representatives by another narrow majority of 221 to 212 with just 2 vacancies. However, on November the 5th, all 435 seats are up for re-election, making this another key political battleground. This situation heightens the potential for market volatility as these various scenarios unfold, creating opportunities for those who are disciplined and well prepared to seize them. However, market volatility also involves risks, and investors should carefully consider their investment objectives and their risk tolerance. As I said earlier, we will discuss risk management further in more detail as we go through the webinar. But if you do have any questions, please feel free to put them on the chat for us to answer for you. Right, let's look at how this could impact our first instrument, the NASDAQ 100. Now, first up, I'm going to run through the key takeaways from the historical performance of the index over the elections in 2016 and 2020, so you get some idea of how US stocks reacted to those previous results. After Donald Trump's victory in 2016, the NASDAQ 100, like other major US stock indices, experienced significant volatility. On the night of the election, as it became clear that Trump was likely to win, US stock futures, including those for the NASDAQ 100, plunged in after-hours trading. You can see this move on the weekly chart on screen right now. At one point, NASDAQ futures were down more than 5%, triggering circuit breakers that temporarily halted trading. This drop reflected the widespread uncertainty about how Trump's presidency might affect global trade, regulation, and technology stocks. However, once the market opened on November the 9th, the NASDAQ 100 quickly rebounded and ended the day higher. Investors had shifted their focus to the potential for corporate tax cuts, deregulation, and infrastructure spending under Trump's administration. Then, over the next few weeks, the NASDAQ 100, along with the Dow Jones and S&P 500, continued to rise. And by the end of 2016, the NASDAQ 100 had gained significantly, finishing the year up around 7% from its pre-election levels. So overall, there was a Trump rally in the markets fueled by expectations of business-friendly policies. Now, looking forward, to 2020, the main takeaway from that election between Donald Trump and Joe Biden was the significant market volatility in the run-up to the election, which was largely due to uncertainty surrounding the outcome and concerns about potential election disputes. This is again reflected on the weekly chart that you can see on screen. The NASDAQ 100 and other major US indices experienced sharp swings, with investors expressing concerns about how a contested election or delayed results might impact the economy and financial markets. And again, this market volatility that was experienced in 2020 is important this time around, given that this election is expected to also be very close and could again be contested in key swing states. Now, once Joe Biden was confirmed as the president, the Nasdaq 100 surged, benefiting from a strong risk-on sentiment in the market. On November 9th, 2020, the Nasdaq returned to record highs and then continued higher in the weeks following the election, driven by expectations of low interest rates and continued Federal Reserve support, creating a favorable environment for growth stocks, particularly in the technology space. Now, by the end of 2020, the Nasdaq 100 had risen significantly, gaining nearly 10% from the time of the election in early November. So I hope that's given you some insight into the volatility and price movement of the Nasdaq 100 over those previous elections. Let's pass over to Richard to talk a little bit about how technical analysis can be used to assist your risk management when you're trading the index over any election. Rich, over to you.
Excellent. Thanks very much, Chris. One of the beauties of technical analysis is that it allows us to prepare ahead of time known events such as the US election. And I'm going to look at a technique that can actually gauge where important levels are within price activity. And if the reaction to the election starts to see these points give way, we may see more significant moves. So I'm going to take a look at support and resistance. Now, a support point is very simply a level where the market has sold off to, found buyers or demand, and that has been strong enough to hold the selling pressure, turn the market higher, and see fresh price strength. Now, resistance is the opposite. So we see the market rallying, moving higher, until we encounter selling pressure or supply, and that is strong enough to turn the market lower and see price weakness. So we can monitor support and resistance points within price activity. So if we start to see these levels giving way, it can perhaps trigger some important price moves. So for instance, back in April and July and June and July of this year, we saw support levels giving way. On April the 14th, we saw closes below the April 3rd correction low, the level where buyers previously had been found to hold weakness. The fact that that started to give way then saw more significant price weakness developing. It was more important back in July this year, when on July the 23rd, we broke below the June 23rd low, where buyers had been found to extend the more positive sentiment. And that created a very significant period of price weakness as the market sold off, having seen a support level give way. So we also saw back in May of this year where the market broke a resistance level. We closed above the March 20th resistance point, the previous high, and that created price strength to extend and see new all-time highs. So how these support and resistance levels are defended are very important. But what happens if we consistently see bullish buying support and the market creates what's called a bullish uptrend, where we're seeing a pattern of higher highs and higher lows? Well, within the Nasdaq 100 index, if we connected the important lows from December 2022 and October 23 and drew a straight line, a trend line connecting those lows, we can see that the rising support acted and held selling pressure in July this year. So the market sold off to the rising support level of the trend line, of the uptrend, and found support and moved higher once more. So is there anything that can actually help us gauge important breaks of support levels and what the market is likely to do after those breaks? And this is where Bollinger Bands come in. And this is my most favorite indicator, and I use this every single day. But a Bollinger Band is made up of three components: the upper band, the lower band, and the mid-average. Now, the mid-average tells us the directional risk. If it's falling, we're in a downtrend. If it's rising, we're in an uptrend. So we can use that within any trading strategy to gauge where directional risks are developing. However, the bands take into account volatility. So if we're trading within a positive trend, the mid-average is rising, and the bands start to widen, we're looking at increasing volatility within that bullish trend. If price is then touching the upper band, the risk is that that volatility will continue to increase and prices will continue to move higher further than most people are expecting. However, when the bands start to contract,
and we look at decreasing volatility, the risk is that we're entering into a consolidation period. And as at this point, if we're long of the market, we may want to stand aside, take profits, and see what happens within price activity. So support and resistance and Bollinger Bands can be very useful in gauging directional risk. If we start to break either support or resistance, it's important. If we start to see Bollinger Bands widening, it's important because we're seeing increasing volatility within that trend. So I'm now going to highlight a couple of slides that you can take a screenshot or a photo of for the key takeaways of support and resistance that we've discussed this evening, and now for the Bollinger Bands, so that we can actually keep this and just gauge the types of signals that we're looking for within this price action. So that's me for this section, and I'm now going to hand back over to Morris, who's going to look at the fundamental side, the strategy side of the NASDAQ 100 index, because even though we know that the US election is coming up, it's equally important to know the drivers ahead of time to see where the directional risks are beginning to develop. So over to you, Mo.
Thanks, Richard. Great job. So what is impacting the NASDAQ 100 index right now? Well, it's being driven by several factors, to be frank, including US economic performance. But with the Federal Reserve data dependent, the NASDAQ is likely to be volatile into the election and indeed afterwards. So, there's a bit of volatility expected through all this. Other factors impacting the current uptrend are any escalation in the Middle East, of course, tensions there rising still, and higher US yields, which historically have weighed on big tech stocks. So, something to bear in mind there. Long big tech, or the Magnificent Seven, as we call them, is still a very popular trade, and their earnings will dominate sentiment. And this starts tonight with the release of Tesla earnings. We get Alphabet, Microsoft, Meta, Apple, and Amazon all through the week, finishing on the 31st. These results will have a big sway on what comes for the next, what comes next for the Nasdaq 100 pre the election outcome. So potential nervousness into the actual election there. With the Fed, what the Fed do regarding interest rates in early November are also an unknown, which may continue to be a challenging factor. The main focus for the Fed is certainly unemployment data these days. So the non-farm payrolls data on November the 1st, with the earnings within that, vitally important data for the Fed. So vitally important data indeed for the markets as well. So with that in mind, let's take a more detailed look at how a potential Harris win or a Trump win could impact the NASDAQ 100. So with Harris, I think one of the things we need to clear up straight away is the fact that right from the outset, both candidates have policies in place that see further spending and pressures being put on China regarding tariffs and chip sales. So I don't think much is going to change depending on who walks into the White House. So we have seen these key policies regarding China impacting the index. And the US announcement suggested recently that the US may actually restrict chip sales to China, and countries deemed less friendly towards the US going forwards. And this actually hit Nvidia. Stocks were down about 5%. It dragged the NASDAQ down about 2%. So you can see this on the screen now. Although the price has tried to recover, the NASDAQ has underperformed the likes of small caps and the Dow over the last few days. So China bashing is not going away, but on the corporate side of things, Harris has spoken about a higher corporate tax rate. Now, this is interesting, moving from 21% to 28%. This is to help fund some of the spending she wants to do, which seems correct, but she's going to be hard pressed to get this through unless she gets a clean sweep of both Congress and the House. So, the House and the Senate are absolutely key to both candidates. They need that in their control for any radical policies, particularly with the corporate tax and spending. But right now, recent betting suggests markets see this as a more challenging prospect for Harris than Trump. But higher corporate tax is not good for stocks. And, the NASDAQ especially could suffer if she is elected. A Harris win could also be negative for big technology companies like Alphabet and Amazon and Apple due to increased regulation. And we've heard already antitrust issues coming up for Google or Alphabet, who owns them. And I think there's ongoing concerns about that. So in this regard, Harris is probably seen as less friendly to stocks, initially at least. Now, Trump is a lot clearer, I think. He's got very determined views. The last time we had the Trump trade, if you like, it led to a US rally in equities after a couple of days after the election, especially in technology and financial stocks. And, you know, many see this as a positive impact if he gets in again. So, but there's still some risks ahead. You know, he's favoring of easy money policies and low interest rates alongside plans to cut corporate tax from 21% to 15%. I mean, yes, that's market friendly, stock market friendly, but what's it going to do to the bond markets and fears over, spending and debt? So a Trump win could benefit big tech with a more hands-off approach to regulation. I get that. Although his more aggressive approach to dealing with China could hurt sales in key markets for some of these big companies in China. So there's going to be a pushback from China. So overall, you know, there's a lot of risks within this, and it's very difficult just to look back and say we're going to get the same thing. So that's the strategy side of the election trading. I'm going to pass back to Richard, who's going to look at the current NASDAQ chart setup. You know, I'll be very interested to see what you see, Richard, because, it's pretty tough to stand in front of at the moment with the gains we've seen.
Excellent. Thank you very much for that, Mo. Great insight as always, and much appreciated. And hopefully I can expand on that a little bit and just highlight what I think are going to be the important support and resistance levels and what are the main directional bias coming into the election and what we need to monitor after the announcement. Okay, so looking at the weekly chart of the NASDAQ 100 index, we can see that it was really the October 22 low that marked the significant turning point, and that brought about the more prolonged phase of strength to new all-time highs that we've recently seen. However, from a technical viewpoint, it was really only in mid-January 23 that the picture started to turn more positive. We saw breaks and closes above the Bollinger mid-average, and then that average turned higher. And it's been that moving higher on a consistent basis that has maintained a positive trending condition and allowing us to view setbacks as a buying opportunity within an ongoing bullish trend. And also the fact that the support levels have developed at a higher level each time gives us confidence that sentiment is still more positive, and that's been backed up by breaks above the previous highs, which were resistance levels, to develop more positive themes. Okay, so how does that leave us at the moment as we approach the election? Well, I think the obvious main resistance focus is the all-time high at 20,759 from the July extreme. And I think it's this point that we really need to be breaking and closing above if the market is going to trigger a more sustained phase of strength. Now, if that does develop, the potential is that we would then extend higher and test Fibonacci extension points of the latest correction move, so those projected upwards. And the 138% level stands at 22,109, which will act as the first resistance point. And if that does start to give way, the risks would turn towards 162% extension at 22,949. So these are the points that I'll be watching if the market does accelerate higher to new all-time highs. However, to the downside, if we start to see more negative themes beginning to creep in, I think it's going to be breaks below the rising Bollinger mid-average, which is currently at 19,429, and closing confirmation of moves below that area could trigger a deeper sell-off. However, I think the September low at 18,556 is a more important focus, being the last correction low of that bullish trend. So if that starts to give way, it may well reflect a more significant negative shift in sentiment and the potential of a deeper sell-off and more prolonged retracement of this October 22 to July 24 strength. So if we do break lower, I think that would shift focus back towards the 38% retracement of that bullish move, which stands at 16,841. And that also links with the April low at 16,970. So this point marks a correction low and a Fibonacci retracement point, adding to the significance of that and potential strength of that support area. If it does start to give way, then the potential may be for a deeper retracement to the midpoint, maybe even the 62% level. But that would seem to be some way off. And I'm going to be watching these first levels, either to the up or to the downside, to really give me an indication of where the directional risks are shifting after the election result. So I'm just going to leave this slide up, which highlights the support and resistance levels, not only for the weekly, but also for the daily perspective. Just allow you to take a screenshot or a photo so you can keep them by your trading system, and just keep a watch on these areas if we do start to see them neared, tested, or even broken. So that's the end of this section. And if you do have any questions, please don't forget to add them to the chart or the Q&A section within Zoom, and we'll get back to you and answer them as soon as we can. But for now, I'll hand over to Chris, who's going to look at gold. Thanks a lot, Chris.
Cheers, Rich. So let's take a brief look at the historical performance over gold during those previous two elections. In 2016, gold prices surged sharply in the hours following Trump's victory, rising by about 5% in early Asian trading on the night of the election. The initial uncertainty over the unexpected election outcome caused this spike, as gold is traditionally seen as a safe haven asset in times of political and economic uncertainty. However, the rally was short-lived. As markets opened the next day, gold began to reverse its gains and started falling, highlighting the flexibility required when trading a US election. Over the next few weeks, gold continued to decline due to rising optimism about the US economy under Trump's pro-business policies, including tax cuts and deregulation. The US dollar strengthened and interest rate hike expectations increased, further weighing on gold prices. Now, by the end of the year, gold had fallen from around $1,300 before the election to $1,150 by December 2016. As we move on to the 2020 election, as the election became closer, gold became more volatile as uncertainty over the election outcome drove market fluctuations. Concerns over potential political unrest or delays in the final election results further added to that volatility. And that's something that shouldn't be underestimated this time around if you're thinking about trading gold or you already have existing open gold positions. In the immediate aftermath of Biden's election victory, gold prices then moved higher. The market expectation that a Biden administration would focus on more fiscal stimulus to support the economy was seen as a positive for gold, since such measures often weaken the US dollar and can increase inflation, both factors that usually push gold prices higher. Is this something that could be relevant this time around? That remains to be seen. So, choppy gold markets were a notable characteristic in the run-up to, during and after the 2020 election. To be prepared for similar price action this time around, there are several things for you to consider in terms of your risk management. Think about whether using less leverage than usual to avoid amplifying losses during periods of extreme volatility could be beneficial to your trading. Position sizing can also be crucial. Consider reducing position sizes when trading around the election to account for potential market shocks or reversals. And now, if you have reduced those position sizes, then consider using wider stop loss parameters, which can help you to avoid getting stopped out by any election noise. Remember, these stop losses can be set on the Pepperstone platform in advance to assist you managing your risk, especially given the key election updates could be out at odd hours of the day when you are not watching the markets. Once you have considered your downside risk, then think about your upside potential. Remember, it's always helpful to set realistic take profit targets. This doesn't always mean that you have to take profits quickly, but it's a good idea to be balanced in your assessment of any potential positive move. Consider basing these decisions on anticipated volatility and historical market reactions to the US elections. If you set wider stop loss levels to account for that extra volatility, then it's sensible to consider wider take profit parameters to benefit from that same volatility. You can also set these take profit orders in advance on the Pepperstone platform to avoid missing out when you are not watching the markets. One final thing to think about is it's really important to avoid over trading. Given the height of volatility, it can be tempting to try and jump on every move with multiple trades. Give careful consideration to any high probability setups you've identified. Consider the creation of a trading plan to help take the emotion out of election trading and support you in maintaining a disciplined and flexible approach to volatile markets. Be ready to adapt to changing conditions, even manually exiting positions if necessary to protect your capital. Right, they are some of the things that benefit my approach to risk management when trading these unique events. Let's now move back to Morris for him to let you know a bit more about what's impacting gold right now. Mo, over to you.
Thanks, Chris. Well, yeah, gold has been making a succession of record highs, as I'm sure you're all aware, driven by quite a few fundamentals, actually, like the Chinese central bank buying that we saw, China speculators, also retail involved, but other central banks also getting involved with central bank buying. And gold is seen as a hedge against inflation, too much debt, and geopolitical risks. So I think some of the drivers of gold are not going to go away anytime soon. But one thing we need to bear in mind is that a higher dollar can weigh on gold and it's susceptible to some nasty reversals, as indeed we've seen recently. But again, the election and what the Fed do a couple of days later could be key for gold going forwards. Geopolitics are also at play with conflicts primarily in the Middle East. And then Ukraine, of course, a key driver of gold prices in October. Gold is not immune to periods of risk aversion. I think we need to bear that in mind. There's times where it seems to do well because it's seen as a hedge against geopolitical risks. But if all markets get dragged down, gold has a habit of going with it if there is a proper crisis. So I think we need to bear that in mind going forwards. So more specifically, how could a Harris or Trump win impact gold positioning going forwards? So I think with Kamala Harris, the markets will be keen to see how much spending she promises, as that is still not clear. But the impact from a Harris win should not hit gold, particularly from what I can see in the first place, unless we get a big move in the dollar. So I think gold it's going to be a secondary move or derivative of a move from any Harris win. The Fed, though, are more likely to cut under a Harris government, and that may take US yields down and the dollar with it. And that actually could be quite supportive for gold because, of course, gold is priced in dollars, and we need to bear that in mind. So that obviously has a direct impact. Risk aversion, as I said, could drag gold down. With positioning still net heavily long in this market, we need to be wary of that. But having said that, a lower dollar could keep the fall to a minimum. Geopolitical issues look likely to remain no matter who is in the White House. And we're not sure how she will manage a crisis in the Middle East if indeed we get an escalation from where we are now, which will be worrying. Although Biden's policy team with which she is aligned have had little success in negotiating any kind of ceasefire. So ongoing problems out of the Middle East to be faced by Kamala Harris as well as Trump, whoever gets into the White House. But gold has certainly benefited from the risk in the Middle East. It seems unlikely the conflict is going to go away. The steepness and the speed of this gold rally, though, is a little concerning because it's beginning to look a little speculative to me in nature. So it's hard to argue against the successive record highs that we've seen. But gold is susceptible to some nasty reversals. And I think we need to just be careful of that with the volatility we're probably going to see into the election. Gold has also gained as the Fed has started to cut rates. There are more rates priced as well. And so that could be supportive for gold into the next Fed meeting a couple of days after the election. So one other issue is whether Trump's spending policies spook markets. And this could be good for gold on a couple of levels, as it's often seen as a haven against higher debt, which is spending, of course, from Trump, and inflation, both of which actually look quite likely under Trump. So this is going to be something I think the bond markets are going to react quite strongly to a Trump win, particularly if he gets a clean sweep. Of course, a higher dollar could be an issue for gold, but the metal is far more popular as a hedge against many current real-time issues than it was when Trump was in power last time. So again, beware of just looking back and suggesting we're going to get the same. A Trump victory could imply the Federal Reserve doesn't need to cut or could even need to hike, for all I know, going on in the next few months, because these policies are sort of designed to boost growth, and the economy is already getting quite a lot of stimulus. And with the Fed cutting rates, even more of a boost. So is there a danger we reignite inflation and the Fed has to start hiking again? Big questions for gold in that as well. So a final consideration are what tariffs and sanctions against China will certainly are certainly going to be a central part of policy again for Trump. That's definitely inflationary on a macro basis. We need to bear that in mind. You know, if we're not going to deal with areas where we can get cheap labor and cheap products, then they're going to be more expensive. It's quite simple. So a final consideration is that, you know, Trump is going to spend, and gold is seen as a potential hedge against this structure, in my view. It's debt, rising debt, unfunded spending. Bonds are not going to like this. And if bonds start going down, yields go up, dollar goes up. Now, that could be weighing on gold to some degree, but if it's seen as a systemic risk, gold will do very well out of that. So I think we need to understand, if we see a move in bond markets, exactly why that is happening. So his spat with China looks set to continue and keep geopolitical tensions elevated, which has seen gold rally in the past. So that's the strategy things on gold for now. I'll get back to answering some questions, but I want to pass over to Richard, who's going to run through the current gold charts. So over to you, Richard.
Excellent. Thank you very much again, Mo. Well, gold has been a consistently strong performer. It's been another market that's been trading within a more aggressive, positive trending condition. And really, since the September 2022 lows, we've been seeing a consistent pattern of higher highs and higher lows as this bullish sentiment has driven the market to higher levels each time. Well, up until recently, gold was finding resistance at 26.95, which was the 238% Fibonacci extension of the last significant sell-off into those September 22 lows. And we did actually see a correction over the last few weeks develop from this region. However, only last week, we saw fresh support materialize, a break higher above this resistance point, and a close last Friday confirming the upside themes were beginning to see fresh momentum to the upside. This week again has extended this move. We've posted new all-time highs, and this seems to maintain the positive trending condition towards next resistance marked by the 2803, which is the 262% Fibonacci extension. And if this gives way, then towards the 300% level at 2976. So it does seem as though, having heard a lot of people talking about 3,000 as a potential objective for gold, as if the technical viewpoint following latest breaks to new all-time highs and those extension points giving way does support that type of backdrop and that type of argument. So it does seem as though coming into the election as if gold can attempt to push towards higher levels. However, obviously, we know that this election result is going to be a very important sentiment driver. So what are the downside levels that we need to be monitoring if we do start to see significant declines developing? Well, that last correction low that we've recently seen at 2602, I think it's probably the first longer term support focus now that we need to be monitoring. If that starts to give way, it would be breaking the pattern of higher highs and higher lows. We would have closed below the last correction low. And that would suggest a deeper sell-off risk back down towards the rising Bollinger mid-average on a weekly basis, which now stands at 25.29. So that again would be an important support level to the downside. If we do start to see that point give way, then it's really the 38% Fibonacci retracement of the February 23 to October 24 advance that would seem to be the next support at 23.95. Now, this is some way below current price activity, so this is why I think we need to focus on the 26.02 low as being the immediate support point. But if that first retracement does give way, then we could be looking at a more extended decline towards the midpoint, maybe even the 62% level, as the corrective themes begin to gather pace. So I think gold is quite interesting at the moment ahead of the election, and it's certainly going to be very interesting to see the reaction to any results. So I will just leave the support and resistance levels for both the daily and weekly perspectives on the screen there for you, just to take a screenshot if you wish, so you can keep an eye on them over the next few weeks and over the election results to see how these stand up and whether or not we're starting to break some important levels. Well, I see Chris and Mo have been answering your questions already on the chat. And if you do have any more, please feel free to type them into the system and we'll get straight back to you as soon as we can. But for now, I'm going to hand over to Chris, who's going to look at sterling versus the US dollar. Over to you, Chris.
Yes, thanks, Rich. If we start by looking at the historical performance of sterling versus the dollar in 2016 and 2020, we see an interesting balance of UK drivers on the sterling side and the US election and its implications moving the dollar on the other side. The initial reaction immediately after Trump's win in 2016 saw sterling strengthen against the US dollar. And as we know, as we've seen from the other markets, this was part of a broader reaction where the US dollar weakened across the board due to uncertainty about Trump's policies and the potential impact of them on the global economy. Sterling at that time rose from around 124 to above 125, and you can see this on the chart on the screen now. However, like the other markets we've looked at tonight, the reaction was short-lived. As the US markets opened on November the 9th, the dollar rebounded strongly, and this reversal was driven by that rising optimism about Trump's proposed economic policies, including infrastructure spending, tax cuts and deregulation, which was seen as supportive of growth in the US economy and inflation. Could we see a similar reaction this time around on a Trump win? It's certainly something to bear in mind. Longer term, in the weeks following the election, the US dollar continued to strengthen due to rising bond yields and increasing expectations that the Fed would raise interest rates in December 2016. As a result, sterling versus the dollar declined from its initial post-election highs above that 125 level down to levels near 120 by the end of the year. Additionally, at that time, the pound was also dealing with its own challenges related to Brexit uncertainties around this election period, which added to downward pressure on the currency. It's also got its own unique challenges this time around as well, which is something Mo will touch on in a bit. Moving forward, in the days immediately following Biden's victory in 2020, sterling reacted positively as investors viewed his administration as likely to bring more stability to US trade and foreign relations. Sterling rose from around 129 before the election to about 133 in the week following the election. The US dollar weakened due to increased likelihood of additional fiscal stimulus and a continuation of that accommodative Fed monetary policy under the Biden administration, which were expected to keep interest rates low. By the end of 2020, sterling against the dollar had traded to its highest point since May 2018 at around 136, boosted by the combination of dollar weakness, positive vaccine news around that time after the COVID pandemic, and optimism around the potential Brexit deal with the EU. And that brings us nicely round to discussing the drivers impacting sterling dollar right now. Maurice, would you say there are several competing themes from the UK and US this time around as well? What are your thoughts?
Yes, thanks, Chris. Yes, there are competing drivers impacting the direction of sterling against the dollar, which we'll go over now. Sterling had been the best performing currency in the G10 space for most of September, doing really well until Bank of England Governor Bailey suggested the UK central bank may start to ease rates more aggressively if data continues to show the fall in inflation. This was quite interesting because the inflation data and all the data we're getting out of the UK was actually quite positive at the time. Having said that, What it did do is spark some pretty serious covering of weak longs in sterling against the dollar. And it dropped over 400 pips from about 134 and traded very briefly below 130 before bouncing. But you can see that on the chart on the screen now. We shouldn't forget this also came at a time when the dollar was strengthening due to pretty strong and a resilient US economy. So the data there had been really strong as well, helping support the dollar. So obviously we have to bear in mind both the sterling factors and the dollar factors with all this. So, what we have seen is the traders have pared back their views on aggressive Fed cuts. And this has shifted the rate differential structure back to being in favor of the US dollar. And that's helped sterling come down. So, what we need to understand here is that for some months, the BOE was rather hamstrung by elevated services inflation. And this doggedly sat above 5%. It was up at 5.6% just a couple of months ago. But the CPI data we've seen recently not only confirmed headline and core inflation continued to fall back to target, but we saw services inflation, a key ingredient for thinking at the Bank of England, start to fall below 5% for the first time in quite some time. And US domestic bonds started to price in a further cut from the Bank of England, and sterling fell, which is when we tested that 130 level. So there are still concerns over a strong labour market and wages. And indeed, retail sales came in very strongly at the last reading, clouding the issue. But the market appears convinced another cut is coming. So they kind of look through that data that we saw on retail sales. On the sterling front, the BOE and traders will need to consider the implications of the UK autumn budget on the 30th of October. I think that could actually be a market mover, and there's quite a lot to come out of there that are still slightly unknown. We should get more leaks into this, but there's a lot of uncertainty around tax rises and spending plans from the new Labour government, and this has weighed on sterling recently. However, once Labour's plans are fully leaked or unveiled, we could get a bit of a relief rally, if there's no other news to counter that. Either way, the next Bank of England rate meeting may be a close call on November the 7th. Now, this is the same day as the Fed announcement, so this could generate some major volatility around for sterling against the dollar in the short term. So just be aware of that. It could be a busy day or two for that. With that in mind, we need to look at the impact of the US presidential election and some of the implications of a Harris or Trump win, which could impact the dollar. So on the dollar side of things, I think a Harris win with the dollar aside of the sterling trade will probably be an interesting one, but may not be as immediately impactful on the dollar as a Trump win. In fact, it could initially lead to a slight weakening of the dollar and thus a stronger pound going forwards. In the longer term, things could play out rather differently, though. So Harris may dump some of the Biden policies, but to me, she seems less likely to spend. Unfunded spending anyway, which could see the US economy slow and the Fed continue to have to cut rates to actually to bring them back more towards normal levels. This could take the dollar lower and sterling higher, although it's unclear. But the fact that Harris appears less likely to gain a clean sweep could make it much harder for her to get some of her more radical policies through Congress and into law, specifically those policies regarding wealth tax and taxes on corporate tax. So moving corporate tax from 21% to 28%, that's not going to go down well. And if she hasn't got both houses, then I fear that she's going to struggle to get those through and into law. But the dollar, if things do go badly, is seen as a safe haven. So we need to bear that in mind if there's any shocks in any of this going forwards. So on a balance of probabilities, the dollar is more likely to fall on any election win for Harris than rise, and that could support sterling on any move higher. But a Trump win, I think this is just so much clearer for markets because the guy is very clear on what he wants to do if he can get them through. All of the Trump policies seem to point to me to higher yields, with the Federal Reserve likely to hold back on any further rate cuts as Trump looks to boost the economy even further. And remember, it's pretty resilient as it is, and lower taxes for business and individuals, which implies heavy spending. Where's this money going to come from? Bond markets could get a little spooked by that. So this could see the interest rate differential shift dramatically in favor of the dollar. And with that, sterling could actually outperform, sterling having outperformed G10 currencies could come under a lot of pressure against the dollar. If we see this bounce in the dollar, those longs are going to be tested in sterling. So to what degree a Trump win could hit sterling versus the dollar is likely to also be dependent on UK inflation, the outcome of the autumn budget, and the Bank of England rate cut expectations. So there's a lot to balance with the two. So we've got the sterling leg, we've got the dollar leg. They've got a lot going on individually, and between them, we're going to get some volatility. It seems for assured almost. What we can do is plan a little bit for the future, where the key support and resistance levels are for sterling against the dollar, and have our technical indicators like Bollinger Bands ready to go if and when volatility does hit. So on that, I'm going to pass over to the expert on this, Richard, to update you on the current situation right now and lay out the key levels he considers important for you to know going into election week. So I'm going to pass over to Richard. Thanks, Rich.
Excellent. Thanks very much, Mo. Much appreciated. I now want to take a look at the technical backdrop for sterling versus the US dollar and what we're likely to see in terms of price activity coming into the election and what are going to be the important focus points that we all need to be monitoring. Well, a theme within the dollar in general has been for further strength, and the last few weeks have seen sterling versus the US dollar encountering quite strong selling pressure as that dollar strength has emerged, and sterling has seen corrective themes. Now, the concern from a technical viewpoint is that this week has seen breaks and potentially closes below what I think is an important support area, around about the 129.93 region, which is the current level of the weekly Bollinger Band mid-average. Now, a confirmation of a close at the end of this week below this point would potentially reflect further deterioration and the potential for further downside as we approach the US election that can see a deeper retracement of the October 23 to September 24 advance. So the next main support from a technical viewpoint, if we do see the confirmed closing break lower to this week, would be down towards the 125.68 level, which is a 62% retracement of that October-September advance. So this could potentially be a hold level if we do see a more extended sell-off beginning to materialize. Now, if we do close below this mid-average, then, as I said, it would be a more negative condition. And that would really suggest that we would have to see a break back above that mid-average, but also above 131.98, which is half of the latest sell-off, because it would really only be then that we would perhaps see further attempts to develop and resume more positive themes to retest those September 24 highs just above the 134.33 area. So I think it's going to be very important, but this week, even ahead of the election, could be quite critical in highlighting where the immediate directional risks lie and if the dollar does have further strength to go. So I'll just leave you with what I think are going to be the important support and resistance levels from both a weekly and a daily perspective for you to take a snapshot of that, just so that you can keep an eye on over the next couple of weeks as we approach the US election. Now, I'm going to hand over to Chris because he wants to take a look at the latest polls and timeline ahead of the US election and what is likely to be the next important drivers between now and November the 5th. So over to you, Chris.
Yes, great. Thanks, Rich. In this final section, I just thought it would be helpful to talk briefly around the most recent polls and then look forward at a timeline of events that you should be aware of that are likely to impact the Nasdaq 100, gold and sterling dollar as we move forward into the election. Looking at the most recent polls, it seems the election race is becoming much tighter as we get closer to election day. Leads for Kamala Harris over Donald Trump only weeks ago have narrowed substantially, and some polls show the race is even tied. Now, I've put a sample of the recent polls on screen for you now. In the key swing states, Harris leads in Michigan, Pennsylvania, Wisconsin, and Nevada, while Trump leads in Arizona, North Carolina, and Georgia. The race is possibly even tighter than the polls suggest, as there is a phenomenon called Trump silent voters, which is a situation where Trump usually receives more votes than the polls suggest, as his supporters don't speak up for fear of being mocked. So this is something that you must also bear in mind. It's a very different story if we look at the betting markets, as you can see on screen now. Taking two examples from the Poly Market and Betfair Exchange, both strongly favour a Trump win, although Kamala Harris is expected to be the popular vote winner, which highlights the expectation of Trump to perform well in those key swing states. So as we come to the end of the presentation and taking all of this into consideration, it's potentially going to be another close election, and that probably means a big increase in volatility across all markets, especially if there's an even bigger shift towards Trump or towards Harris in the polls closer to election day. So keep an eye on the polling data and the betting markets to stay updated on when the trend is moving in the next 14 days. There is always the chance of some surprise moves. Follow how this is evolving over election night. Pay close attention to what the exit polls say. I often find it's worthwhile keeping updated with real-time election news, key political announcements and post-election speeches, but make sure you use those reliable news sources and election result trackers. I personally use Bloomberg, Reuters and CNBC for my real updates, but there are many others, and Pepperstone have a fantastic team as well, which I follow regularly via X. And then just briefly, before we go to questions, let's look at that timeline of key events that I've put on screen for you now that may impact the three markets that we've discussed today. It starts with Tesla earnings tonight, as Morris said earlier. We've got Bank of England Governor Bailey speaking as well tonight. And then as we move forward into next week, we've got Alphabet earnings, the UK autumn budget statement at the end of the month, the US PCE inflation, which is the Fed's preferred inflation gauge, before we move on to payrolls on Friday, the 1st of November, then the election on the 5th, and then the Bank of England interest rate decision and press conference, and the Fed interest rate decision and press conference at the end of that period on the 7th of November. Alongside the geopolitical events in the Middle East and Ukraine, there is definitely a lot to focus on going into that Fed meeting on the November the 7th. So between now and then, prepare for volatility, be disciplined in your trading, do your research on chart levels and potential outcomes for the election. And with that, let's move on to those live questions. Great, thanks very much, guys. So we just to kick off this Q&A section, so we appreciate your time. Thanks for staying with us. Just to kick off this Q&A section, we've got Mike Baker from Pepperstone here with us. He's head of UK sales in Europe. So he's going to ask the first question of us, the mentors, but he's also got some great stuff he wants to show you about the platform as well. So Mike, over to you.
Thanks, Chris. Yeah, that was a very informative webinar. So thanks for all the information. When I've looked at sort of these elections in the past, and especially from a trader's perspective, you kind of have two ways or two sort of events that sort of crop up. There's the actual election night itself, where traders will be glued to the screen and they'll be looking at the sort of exit polls, and they'll be following along, and they'll be looking at the market reaction. And even though it'll be thin as it goes through the night or get towards the end of the market close, you'll see a lot of volatility, and they'll be trading those sort of conditions. And then in the coming days as well, you'll see traders sort of start to position themselves for sort of a longer term move. So given the sort of historical volatility around election night itself and then post-election, what's the sort of measures that you would recommend traders, that you would recommend to sort our clients that use our platforms what to take when they are trading a potential market. So say we're going to use sort of the NASDAQ 100, that's going to be, it's a super popular market, major index. That's what a lot of our guys would use. What are they going to be doing throughout that night and throughout sort of the coming weeks to prepare, well, to protect themselves, to prepare themselves for what generally is quite large market moves?
Well, if I can answer that, I've traded through some of these things many times before, and there's a couple of points I think we need to bring up here about trading these events, Mike, is that, there's going to be volatility into the night, a couple of days before. We're already seeing some moves. It looks to me like the market is starting to price the Trump win. We've got yields higher, we've got the dollar higher. Stocks are just having a bit of a wobble today. We're starting to see the higher dollar impact. But I think the big guys, the real money traders, are going to wait until the dust settles. So maybe a day or two later, let things calm down, see what's going on. I think for retail and your customers in particular, there's going to be opportunity the 2 days before and the 2 days afterwards. But getting married to a trade, as we call it, sort of sticking to a strong view over those 4 days is going to be very difficult to hold on to. So, I think you need to be opportunistic, relatively short term in your trading. Grab your profits when you see them. And then I think if you want to take a longer term view, just wait for the dust to settle just a little bit before taking that sort of, because I do think there's going to be a longer term macro move on the back of this, particularly with a Trump win. And then we've got to factor in the surprise, and that at the moment would be, say, a Kamala Harris win, and taking a clean sweep. That would be quite a shock, I think, to most people in the markets that I talk to in my realms. I don't know if you agree with that, Chris.
Yeah, I mean, I was going to say, from my point of view, I think that's absolutely it. I think that the market is pricing. It seems to be it's kept buying stocks on the back of a business-friendly Donald Trump. I think an initial shock would be a Kamala Harris win. The market will probably, in my opinion, may take that like very short-term negative before it then actually calms down a little bit, and then look, and suddenly decides on what that actually could mean, which is probably the status quo remains the same. So the Fed keep cutting rates and things like that. So I think that could be the thing that markets need to digest in the short term.
Yeah, I think one thing on this, Mike, is that no matter who's in the White House, Harris or Trump, both are going to spend more, which I think the market's getting a little worried about now, and both are going to keep up this pressure on China. So the global trade aspect of things and those trades associated with weakening global trade and global friendships is a concern that market traders will probably take note of going into this and out of it as well.
I think from the technical perspective, I think you just keep things disciplined, keep things very tight, be aware of the important levels as we come into the to the results, be proactive ahead of those levels, but also keep things relatively small in terms of positioning. Make sure you have stops in, and just be protecting your positions if you start to see important levels giving way. And the beauty of it is, as we were saying in the webinar, is that you can just be pre-armed with those levels, and you can react to the announcement and any volatility that we see using those tools. But just keep everything disciplined. Don't get drawn into what you think is a particular move when you're testing a resistance level. Just look at those as being an important focus for the market, and be able to react to those as and when they occur.
I think one other thing is as well is that, depending on if you want to trade over the actual election itself, then you have to be watching, get the news source, whether it be Reuters, Bloomberg, CNBC, that you trust, because that information is going to be coming in thick and fast. So it could be, if suddenly a swing state like Georgia goes to Harris, and that's a shock when the market was thinking another way, that's going to have an impact on stocks, the dollar, sterling against the dollar, the NASDAQ 100. Certainly you're going to see that react to that. And then obviously it might switch the other way as the next one comes in from Arizona. So, you have to be ready to keep following that overnight, because the market is going to be like a pinball machine. It's going to be back and forth unless there's a very clear winner, of which, of course, that could see a move one way very quickly. So we have a question on the chat. Somebody was saying, when you see a big impact news coming in, how much weighting should you give prior technical analysis, Rich? So say when the Fed are going to cut 50 basis points, they cut 50 basis points rather than the 25 that the market was maybe expecting.
Yeah, I mean, I think personally, I would put just as much influence on past technical levels within that type of environment. I mean, there are always the surprise moves by a Fed cutting more than anticipated, resulting in the election, whatever, and that will bring about increased volatility and perhaps surprise moves. But you can still use and use the emphasis of technical analysis within that type of market. You can, for instance, the Bollinger Bands, when you're seeing that increasing volatility, so you're reacting to that positive or negative positioning and increasing volatility within that move. But the previous technical levels are just as important within that type of environment, because they do still act as support and resistance levels, and you need to be aware of them.
I think there's one thing we could add to that, Mike, if you don't mind, is that, if you've got your parameters set and an unexpected news event comes out, then you don't have to wait until your stop loss is done. If you think this is an event that's going to change the market structure, then get out. I mean, keep yourself flexible within this. But I agree with Richard, if it's moving okay and it's not too volatile, then stick to your principles, stick to your levels.
So somebody was asking, saying they love the chat so far, which is obviously good to hear. But they were saying, could you talk a little bit more about the reasoning behind the correlation of the dollar and US yields, and maybe what's happening right now, Mo? Because obviously yields are higher and it's dragging the dollar up higher as well. So tell us a little bit more about that. Your thoughts on that?
Yeah, I think a lot of people saw this 50 basis point cut from the Fed as being dollar negative, and to start with, for a day or so it was. But then, the potential impact of the election and a Trump win started to gain some momentum. But also, we saw some very strong economic data. The unemployment data came in much better than expected. CPI was slightly higher. And what happens is the market starts moving the interest rates expectations. So from Fed funds at the very short end through to sort of 10-year yields, 20-year yields, 30-year yields, they all started to rise because the market suggested that although they've cut 50 basis points, the need to cut further is diminishing. And so therefore yields rose, and that takes the dollar with it. And when we get these moves of this degree, the dollar does follow 2s and 10-year yields, depending on which one's most dominant. And so, yes, we've seen the policy move, but don't forget yields move on their own. So bond traders, markets are forward looking. And so bond traders are looking at the Fed and saying what we first thought was the case with further cuts is no longer the case. And so therefore, with reduced cuts, yields have to rise. And that's what we're seeing. And the dollar is following those.
Do you see that maybe changing, Maurice, if like the yield move and then the dollar move, if Kamala Harris was to suddenly maybe win the presidency?
I think there is something in that, Chris, because I think Harris's spending promises are far less than Trump's. I think she's more the status quo rather than radical. I think bond markets might quieten down a little bit, and you could actually see a Harris win being negative for the dollar, but I don't know how far. It depends on if she gets a clean sweep, how much of a majority she's got in the House. All of these things are factors. So, there's going to be volatility around this. I'm sorry, I can't give you a direction. We're not here to give recommendations, but to highlight some of the risks. And, these bond markets are very, very impactful for the dollar, which then, as we've seen today, this higher dollar has started pressing on commodities today. We've seen gold down, we've seen silver down 3% today. This is because of a higher dollar and some risk aversion going on. So stocks have started to feel a bit of pressure from this as well. How much is Trump going to spend if he gets into the White House? And as we saw with Liz Truss in the UK, bond markets can take a very dim view of spending, unfunded spending.
Somebody was asking, Maurice, and I know you said about the gold move and that you brought that up in the webinar, risk aversion and the higher dollar that has an impact on gold, and that's what's happening to the commodity space right now with the precious metals, isn't it? But someone's asking, where do you think the neutral US interest rate will sit? You know, in other words, where do you think the Fed may stop cutting, or is that dependent on who if Trump gets in as opposed to the status quo of maybe Kamala Harris?
Okay, on the neutral rate, the R star, if you like, as they call it, the neutral rate of interest rates, where it's no longer stimulating the economy or pressing on it, is an unknown science. So the Fed guesses this. I mean, the idea is that it's moved from 2.5% closer to 3.5%, which means, therefore, that rates at 5% were not as restrictive as we thought. So, where is the Fed going to stop cutting rates? They're data dependent. We must listen to that. They are data dependent. If this data on November the 1st, we got non-farm payrolls, unemployment data, we've got ISM data coming out as well. We've got JOLTS, we've got ADP next week. With all this data coming out, if this data is all strong, there's a very good chance they don't need to cut anymore. And remember that whilst the Fed has boosted the economy with a 50 basis point cut, the government continues to boost the economy with spending, and they're going to spend more when the newcomer is in the White House. So, there's quite a boost sitting there for an already quite strong economy. And so, it's pretty clear that the economy is going to stay relatively strong through this. And that means the Fed may not have to cut at all. We just don't know. At the moment, we're pricing in just under 25 basis points for November. I think there's a chance they may not cut, but it's a close call, and we need to see that data.
And obviously, Rich, we're seeing that play out across the dollar, the dollar strength across everything. Sterling's lower, the euro's lower, dollar yen's higher. Have we reached like a tipping point where everybody's cutting their dollar shorts? Are you seeing that right now, or is it just pure dollar strength?
I think there is something behind that potentially. Certainly when last week's activity in the dollar took us back to sort of important resistance points for the dollar against potentially overextended conditions. And if we were going to see a turning point, it may well have been against those types of levels. For instance, from the sterling dollar, the rising Bollinger Mid average, for instance, on a weekly basis. But the thing is, we're now starting to see these levels give way this week, and that tends to highlight the risk of either people are continuing to initiate long positions, or they're cutting their original short positions in the dollar, and that is being enough to generate further dollar strength. And certainly, it does look over the next sort of few periods that we can see that move continuing. And I think, if they haven't cut shorts within that move as yet, that may well be a risk over time. And that would again sort of highlight sort of more acceleration within the move. But the important point is, I think for the dollar, it's broken its levels this week, and that tends to suggest that further strength is a possibility.
And are you seeing anything in the stock markets at the minute? I know they're down today, but do you see anything in the stock markets that you think are having a similar sort of move, or are they just it's the ebb and flow right now? They're still in an uptrend, and 2%, 1% for the Nasdaq, it's no problem. That's what it's doing at the minute.
Yes. I mean, obviously the markets are lower today across the board. We're breaking sort of first short-term support levels, which could be viewed as a bit of a concern. But we've seen this type of move before, and it's just sort of continued to run into fresh buying support, and it's extended the ongoing positive themes. I think there is the risk that we are at overextended upside conditions within stocks, and that may well be due for some sort of reaction, some sort of unwinding of those extremes. But I don't think today's move on its own confirms that that's more likely now. Yes, the risk may have increased up a notch, but I don't think that we've broken any significant levels within the equity markets to suggest that we are starting to see the long positions being unwound just yet.
Great. So there's another question coming on the chat, so keep them coming. Sorry, not the chat, on the Q&A. Maurice, one for you, I think. What are the factors or the potential data that is going on behind the scenes that the MPC, the Bank of England, is looking at to decide whether or not to cut rates in November or even more aggressively in November, December, and going into early next year?
Yeah, I think there's a couple of issues going on in the background. I mean, if we look at what the focus is at the Bank of England, what they are focused on, it's wages that are beginning to sort of just drift down a little bit. But one of the biggest problems is, whilst headline and core inflation have moved back to target, services inflation, which is us spending money on enjoying ourselves, like hotels, holidays, bars, restaurants, services inflation is still at 4.9%. So this is a bit of a concern because they're asking themselves if they need to boost the economy. Also, the other thing that they're focused on is growth, obviously, and growth data in the PMI data that we see looking forwards and some of the GDP data we've seen recently is actually better than we expected. So this is kind of hamstrung the Bank of England about whether they want to go full on for another cut or not. So I think the next meeting is quite a close call, to be honest. I don't think it's guaranteed we get another cut at all, although the market is beginning to price that. I think that again, this is another central bank that is data dependent. That makes our job very, very difficult because we have to go with the ebb and flow of the data as it comes in. So, Chris, the major factors are wages, where they're going, services inflation, and growth. So, around those, we need to look at the data that corresponds to that into the next meeting. And just to let you know, the next meeting is exactly the same day as the Fed's meeting on the 7th of November. So the potential for a dollar move and a sterling move, if you trade cable, sterling against the dollar, then we could have a busy day.
Do you think that sterling, like on the dollar side, that the central bank, the Bank of England, the Fed are waiting? So the Fed are waiting for who wins the presidential election because that's going to have a big impact on their thinking on whether they can cut rates and inflation. Do you think the Bank of England is waiting or in a similar wait and see mode around the UK autumn budget, or is that overhyped potentially, or or could it be big?
I think it's usually slightly overhyped, but I think this one could be different. It's a new government. We haven't seen these people in power before. A lot of new people in new positions. There is some concern over what Reeves wants to do with taxation and the rest of it. That she's trying to put in a little bit of austerity into this, which is unusual these days. Makes sense, but what does that do to the economy? So, I think the market could react to that. And I think it also could impact if it's a very disappointing budget and the market start to come off, the Bank of England may not have to cut quite so aggressively. So, it is going to add to it. But they've promised that not going to do so much with tax, with VAT, income tax, and the rest of it. There's only so much they can do, Chris, to be honest. So I don't know. I think it's slightly overhyped, but I think that the central bank is in a good position because they get a week to sort of go through everything before they have to make a decision.
And do you think the Bank of England is looking at also the US presidential election as a potential tipping point as well, right? They don't want to rush to cut rates if Trump gets in and inflation is a lot higher, because that's going to come across to our side of the country as well, of the world. Sorry.
Absolutely, and it's not just the Bank of England. The ECB will be looking very closely at this as well. Trump is talking about 10% tariffs for everybody, maybe even 20, and maybe 50 or 60% for China. So look, everybody's going to be in the same boat here. So they want to see if he's going to win. The Bank of England also may want to wait until they see what the Fed does. And remember, the Fed is in the evening of the central bank of the Bank of England's meeting. So they may want to leave it a month, because if they don't do anything, then the dollar's going to go up and sterling's going to come off anyway, which obviously helps their import base, so their export base. But I mean, I think realistically, the economy is at a bit of a pivot point here in the UK. Does it need another boost yet? There's some extenuating factors that they may need to see before they can afford to go for another one. But I think it's going to be a close call on the 7th of November.
Somebody else was asking, the last 2 weeks, the dollar and gold have been rising, and what they were saying, is that usual? And also, what was the, sorry, let's start again. What were the reasons behind that?
Yeah, well done, Chris.
Not easy for me to say.
Yeah, I'll have those teeth back when you finish one. I think thing with gold and the dollar is that that we've seen an unusual move, because remember, gold is priced in dollars, so one would assume a higher dollar actually weighs on gold. But what we did see, whilst the yields were rising and the dollar was rising, that there was an awful lot of um, pricing of a Trump win going in, and that was higher inflation, good for gold. It was rising geopolitical tensions with Israel about to go in and possibly hit Iran installations. Were they going to be oil? Were they going to be nuclear? We didn't know. We still don't know. That's kept the market tight as well. So in that environment, you can actually get times where both gold and the dollar rise together. But today, for instance, the weight of that rise has started to weigh on these commodities. And I say, they're lower today. And I think that's mainly dollar driven. So we do get these reversals in gold and silver, and they can be quite brutal at times. But you do get times when they move in tandem. And it's like stocks. Sometimes you get stocks going up and yields going up. You would expect that to weigh on the NASDAQ in particular, but sometimes it doesn't. There's extenuating circumstances there. And gold appears to many people right now to be a hedge against just about everything.
And usually the one thing it's not a hedge against is just overdone positioning, right? And that's maybe what you were talking about as well. And I know somebody on the chat was talking about that as well, that, you get this one-way positioning and suddenly there's no one else left to buy it at these current levels.
What I would say is the positioning looks a little speculative to me. I'm not surprised we've seen this 1.5% move back down. I do think this is classic gold. But I think the demand is still out there for this until we get through this very uncertain period of geopolitical risk and political risk. So maybe the dip is going to be minimal, but it's quite a healthy thing for this to happen to markets that are trending higher. But it just looked a little bit speculative to me over the last few days.
Rich, do you have any more to add to that?
Yeah, I think basically gold has almost reached the extent of the elastic band stretching, with the dollar sort of strengthening the way it is, and you do get these snapbacks, which can be quite painful occasionally, but the general trend is still very much there. And I think the positioning is such that it is overextended. You are seeing exhaustion, and I think this week's or today's move in particular is perhaps a sign of that, in the way that we've sort of traded up to short-term resistance levels. We've found selling pressure. There's signs of exhaustion. The upside momentum's beginning to come out of the move. But as Mo said, you very often see these corrective themes develop within gold, and it's better not to chase prices higher when you reach that sort of maximum extent of the overextended conditions. So I think it's healthy to see this type of correction, and as long as the bullish trending conditions remain in place, the risk is that will be a limited move before we see further attempts to push higher again.
I mean, the one thing I was thinking about that in terms of this whole move, certainly this week, is the market is light on data. So other than maybe I think Kamala Harris is on CNN. You've got polling data. You've got Tesla. At some stage later this evening, that can move obviously the Nasdaq 100 one way or the other, and certainly influence sentiment tomorrow, especially if the news isn't good. But then there's nothing. We've got some PMI data tomorrow, but there's really nothing else this week. And then we're suddenly into a very, very busy data week next week. I know, Morris, you and I were talking about that, how much data, and we've got 5 of the Magnificent 7 stocks earnings out next week. We've got, and then suddenly we're into the election itself. So this is a critical period, and maybe there's some risk adjustment going on right now just to lighten the load as we come up to so many different possibilities in the next 2 weeks. Moving forward from Monday.
There's a lot of risk out there. We've got the Bank of Japan meeting. We've got a Japanese election this weekend. We've got tier 1 data all through next week, culminating in the non-farm payrolls on Friday. And then we move into election frenzy really after that. So a lot of uncertainty, a lot of risk, and a fair amount of volatility.
I think
so. Hey guys.
Oh yeah, Mike, that's it. I know that you wanted to share some stuff about the platform.
Yeah, that's right. Yeah, I wanted to show the platform. So bear with me for a second while I just load my screen. Yeah, can you see it?
Yep, that looks good.
Brilliant. So you would actually, I was just catching up with the Nasdaq. Then what's caused this? Got a nice sort of 400-point drop there, haven't we? From
Yeah, I mean, there's been some risk aversion today, Michael. We've seen higher yields, a higher dollar, and basically that started to roll everything over. So it started with commodities coming off. The Dow Jones seemed to lead it initially to start with, and then it just kicked in. I think there's some nervousness around Tesla results tonight as well. So I think it just all culminated with people saying there's so much risk out there. The short-term guys are taking some off the table.
oh, okay. Well, as you guys can see, this is our new platform. So this is the Pepperstone Trader web platform. So it's got all your nuts and bolts, all your bells and whistles. Very easy. I think this whole kit has actually been built more towards the execution side. So the one-click trading is a very popular tool that we're finding with all our traders at the moment. The ability just to jump in very quickly and to close positions very quickly as well from the positions. Tab down here. Okay, so easy to get in from just clicking the sell or the buy to open up positions. Easy to close as well from the chart as well. You can close it down, double click, you can move the chart, you can do everything there as well. So it's a very easy to navigate platform, very simple to use. And do strongly recommend if you're using one of our sort of other platforms, a C Trader, or you're using one of our MetaTrader platforms, or maybe using our Trading View, then do have a look at the Pepperstone's own platform as well. You can actually get on the mobile, very easy to navigate, and yeah, we're seeing it very popular. We're having quite a large uptake. So if you guys do get a chance to do take a look. Back to you guys.
All right, thank you very much. Just one very quick question before we leave it then. Rich, what do you think about the current downtrending sterling? I know you went through it in the webinar, but do you see this as sustainable? Are you really waiting to see, do we get the weekly close? I mean, it's trading close to 125 or 129. Is it a wait and see? I mean, there's a lot of work being done to get it down to this level, it seems.
There is. I mean, it's felt quite a while to get down to these sort of these areas. It's sort of held around the 130 area. That's been a bit of a pivotal focus. There's been sort of increased two-way activity around that point, around that weekly Bollinger mid-average. But the fact that we are breaking lower, it does tend to suggest that the downside risks are materializing, and those daily support points that we highlighted within the webinar may well sort of come into play to the downside. But certainly with today's move, it seems as though it's extending the downward trajectory here, and that risks are that we could still see further weakness.
So with that, we'll wrap it up. Thank you, Michael, for coming on and joining us this evening. Thanks to everybody else for your great questions and for staying with us and watching our US election talk with Pepperstone. So hopefully we'll see you again soon. Otherwise, have some very happy trading out there. Be disciplined, be sensible, and we wish you all the best for the next 2 weeks. See you soon. Thanks very much.